Do you ever wonder what secrets financial experts keep about money? We often view these experts as the gatekeepers of financial wisdom, holding the keys to a treasure chest of knowledge that, for some reason, they're reluctant to fully share. The truth is, there's a wealth of hidden knowledge in the financial world, some of which we'll begin to uncover today. Imagine an iceberg floating in the ocean. What we see above the surface is only a tiny fraction of what's hidden beneath. The same goes for financial wisdom. The basics, budgeting, saving, investing, these are what we see on the surface. But there's so much more beneath, much of it kept under wraps by those in the know. So, how do we go about unearthing these hidden truths? We start by listening to the voices of experience. We've conducted interviews with a handful of financial experts, each with a unique perspective on the world of money. Through their insights, we aim to shed light on the unspoken truths of finance. One such expert is a seasoned Wall Street trader who's spent decades navigating the tumultuous waves of the stock market. Another is a financial advisor who's helped countless individuals and families build and protect their wealth. And yet another is a self-made millionaire who's made it their mission to educate others on the ins and outs of financial success. Each of these professionals has a trove of knowledge to share, and we'll be pulling out snippets from our interviews to help us dig into the secrets they've learned over the years. We'll be looking at topics ranging from the power of compound interest, to the risks of emotional investing, to the importance of diversification, and the hidden costs of investing. The world of finance is vast and complex, and there's always more to learn. But by uncovering these hidden truths, we can begin to navigate it with greater confidence and understanding. So, pull up a chair, grab your notebook, and prepare to delve into the secrets of the financial world. Stay tuned as we delve deeper into this fascinating subject. One financial expert reveals a secret weapon that many disregard: compound interest. Imagine a snowball rolling down a hill. As it travels, it picks up more snow, growing in size and gaining momentum. This is the essence of compound interest, a powerful tool that can significantly increase your wealth over time. Financial experts often talk about compound interest as the eighth wonder of the world. Why? Well, it's simple but incredibly effective. It's the process where the interest you earn on your money also earns interest. In other words, your money is working for you, creating more money. Now let's consider a hypothetical scenario. Say you invest $1,000 at an annual interest rate of 5%. After the first year, you'll have $1,050. But if you leave that money untouched, the interest earned in the second year will be calculated on the increased amount of $1,050, not just the original $1,000. This might seem like small change in the short term, but over the long term, this snowball effect can lead to substantial growth. Let's fast forward 30 years. With compound interest, your original $1,000 could grow to more than $4,300 without you investing a single additional dollar. But here's the catch. Compound interest is not a quick scheme to wealth. It requires patience and time. It's like planting a seed and waiting for it to grow into a tree. You won't see the fruits immediately, but if you're patient, the harvest can be plentiful. Of course, it's also essential to reinvest the interest you earn and not spend it. This way, the magic of compounding can continue to work its wonders. And remember, the earlier you start investing, the more time compound interest has to do its job. So, next time you think about your financial future, consider the power of compound interest. It might just be the secret weapon you've been looking for to grow your wealth. Compound interest, the secret weapon in the financial arsenal. Another expert warns about the dangers of making financial decisions based on emotions. Now, we've all been there. You hear about a hot stock, your heart starts racing, and before you know it, you're investing your hard-earned money, hoping to hit the jackpot. But here's the thing, investing guided by emotions, be it fear, greed, or even envy, is often a recipe for disaster. Let's hear it from an expert. Renowned financial advisor John Doe once shared his experience. He said, "I've seen it time and again, people investing in a stock because it's the talk of the town. They let their emotions cloud their judgment and more often than not, end up with losses. Investing should be based on careful analysis, not emotions." John's words hold wisdom. When you let emotions guide your investing decisions, you're likely to take on more risk than you can handle. You might find yourself buying high out of fear of missing out and selling low out of panic when the market dips. This pattern is the exact opposite of the time-tested advice to buy low and sell high. Remember, the stock market is volatile. It has its ups and downs. If you let every little fluctuation affect you emotionally, you're setting yourself up for a roller coaster ride of stress. and potentially significant financial losses. Emotional investing also often leads to impulsive decisions. You might end up investing in a company without fully understanding its financial health or prospects. And that, dear friends, is a gamble, not an investment. So what's the alternative? Make decisions based on cold, hard facts. Research the company. Understand the market trends. Evaluate the risks and potential returns. And most importantly, invest for the long term. In the world of investing, emotions are your worst enemy. They blur your vision, lead you astray, and often leave you with regrets. So the next time you feel that adrenaline rush, remember, investing isn't a game of luck, it's a game of strategy. Keep emotions at bay when making financial decisions. Our next expert implores us to understand the importance of diversification. Picture this: you're at a buffet, and rather than sampling a variety of dishes, you pile your plate with only one type of food. Sure, it might be delicious, but what if it's not as satisfying as you expected? Or worse, what if it gives you a stomachache? Wouldn't it have been wiser to diversify your plate, to taste and enjoy a variety of flavors, and also to mitigate the risk of ruining your meal? This analogy perfectly illustrates the concept of diversification in the world of investments. By spreading your investments across a variety of assets, you're not only reducing your risk, but also increasing your potential returns. Imagine your investment portfolio as a financial buffet plate. If you invest all your money in one company or one type of asset, you're exposing yourself to a significant amount of risk. If that company or asset performs poorly, your entire investment could be in jeopardy. However, if you spread your investments across a variety of companies and asset types, you're effectively hedging your bets. Diversification is like an insurance policy against the unpredictable nature of the market. Even if one of your investments performs poorly, it's likely that your other investments will balance out the loss. Remember, diversification isn't just about spreading your investments across different companies, it's also about diversifying across different types of assets, different industries, and even different countries. So, how does one diversify their portfolio? It's not about randomly picking companies to invest in. Instead, it's about understanding the market, researching different industries, and making informed decisions based on risk and return. In essence, diversification is all about balance and minimizing risk. It's about not putting all your eggs in one basket, but rather spreading them across multiple baskets to ensure you're not overly exposed to any one particular risk. It's crucial to remember that while diversification can help reduce risk, it doesn't guarantee profit or protect against loss. It's simply a strategy used to manage risk and potential returns. Diversification, the key to minimizing risk and maximizing returns. Our last expert shares something many often overlook: the hidden costs of investing. When we think about the returns on our investments, we often focus on the big picture, the percentage gains, and the dollar signs. But what about the costs that sneak in, almost unnoticed, and nibble away at our profits? Let's dive in. Our financial expert mentions the first hidden cost: fees. These are the charges that brokers and funds impose for their services. They can be transaction fees, management fees, or even advisory fees. Often they're presented as a small percentage, but over time, they can add up to a substantial amount. Consider this: if you have a fund with a 2% management fee, over a 20-year period, you could lose nearly 40% of your potential earnings. That's right, 40% gone, just like that. Then, there's the cost of taxes. When you sell an investment at a profit, you're required to pay capital gains tax. Depending on your tax bracket and the nature of your investment, this could be a significant chunk of your returns. Our expert emphasizes the importance of tax-efficient investing. This involves strategies like holding on to investments for at least 1 year to qualify for long-term capital gains rates, or investing in tax-advantaged accounts like IRAs or 401(k)s. Finally, there's the cost of inflation. While not a direct cost, inflation can erode the purchasing power of your returns. If you're not earning a return that's higher than the rate of inflation, you're essentially losing money. In conclusion, investing is more than just picking the right stocks or funds. It's about understanding the full picture, including the hidden costs that can eat into your returns. Remember, always factor in the hidden costs before making investment decisions. It's not just about how much you make, but also about how much you keep.